Hey everybody, MortgageSeth here. A lot of hype going on in the financial markets right now, and the news is going crazy. All the coronavirus talk, what that means for the financial markets. So I just wanted to pop in with a quick video to give you my perspective on it and to let you know what you should look out for. I think that with this emergency cut that the Fed has made, it's 50 basis points. That's a 0.5%. It's a huge cut. It's kind of historic that we're seeing this big of a cut going on right now. Wasn't expected to be this big, but with all the things that are going on in the economy and the fears around this virus, they had to take some action. They felt like they did to try to stabilize things and stimulate the economy to keep it going. So this 50 basis points, the 0.5% cut, why did they do it? What does it mean to you? The Fed's rate cut is in response to the growing concerns over this virus, of course, the coronavirus, and what it's going to do to the economy. So we have to keep in mind that a Fed rate cut, it can lower the borrowing costs on short-term rates, such as credit cards, home equity lines of credit, those types of things, anything tied to the prime rate. You'll see those rates drop pretty much instantaneously. Now that the Fed has dropped their rate, you'll see the prime rate go down, and that's what a lot of the short-term interest rates are based off of, is the prime rate plus some kind of a margin. So any of those short-term debts that you have with credit cards or lines of credit, that's where you'll see a big impact. The payments will go down, you'll be paying less in interest. But it doesn't necessarily translate to long-term rates like mortgages. Mortgages are usually over 30 years. They're tied to the bond market. They usually follow the 10-year treasury. So think about this, that the Fed can quickly make changes, but mortgage rates, since they're fixed for up to 30 years, there's not really a direct correlation between the two. They're related, of course, but they don't direct. It doesn't directly mean that if the Fed cuts the rates by 0.5%, that your mortgage rates are cut by 0.5%. So keep that in mind. It's related, but not directly tied to it. So mortgage rates were already moving in the downward direction, and we're at a historic low right now. The mortgage rates have been moving down. We've seen what's been happening with the stock market, and rates tend to go down as the stock market goes down. People are pulling money out of the stock market, putting it in bonds, and that strengthens the mortgage market, which makes the rates go down as well. So mortgage rates are already going down. We've hit an all-time low. So if you think about a comparison from where we are now to the time that everyone talks about in the 80s, where rates were 17, 18, 19%, and that was acceptable. People were still buying homes. People were still having long-term financing that they could restructure later when rates went down again. But the normal interest rate that we see is in between 6 and 7%. That's kind of the norm where we expect rates to be when things are stable, maybe a little bit lower, a little bit higher. But keep in mind that interest rates now that they're down in the 3%, maybe even going lower at this historic all-time low, this is basically free money. It's really making the affordability of housing a lot higher. People's wages have been going up and the interest rates going down, so that means that more people can afford homes. The payments are lower on those mortgages. So keep that in mind if you're a buyer, if you've been sitting on the fence and waiting, you've been seeing prices going up on homes over the past months and years. Now's a great time to lock in on these low rates that who knows how long they're going to last, but we probably won't see them again once the correction happens and rates are up over 5% again. You'll be glad that you locked in on these 3% interest rates that are out there, maybe even lower if they go lower. So they're already moving in this continuously lower historic trend that we've seen. Last Friday, yesterday on Monday, we saw some of the biggest drops we've seen in the mortgage market just over a couple of days. And remember, again, they're at their lowest levels in history. So right now is a great opportunity. If you've got a mortgage that you've even refinanced 6 months ago, it's worth taking a look at, talking to someone how you can structure that so that you're not repaying all the costs maybe that you paid with that loan. Hopefully you didn't pay points when you were refinancing if it was in the last 6 to 12 months. But there's ways to structure the debt where you don't lose the time that you've already paid on your new mortgage. You can do a mortgage for 29 years, 28 and a half years, whatever the term is, so you don't have to reset it if you don't want to. But talk to somebody who can help guide you through those options to see what the best is for your specific scenario, because there's a lot of flexibility and everyone just gets so focused on the rate. That's what the news is talking about. So the rate, of course, is important, but it's not the be-all, end-all. You don't want to get pulled into getting this lower rate just to say that you've got the lowest rate possible, when in the background you don't realize that there's extra fees associated with that, or there's something going on that's getting you that low rate that may not seem realistic. So just keep an eye on that. Have somebody working for you that you trust so that they can get you into the right loan program for your specific scenario. Remember, the terms are flexible when you're talking about how long you want to have your new mortgage for. But the bottom line is just talk to somebody who can guide you through these times, because there's so much misinformation, so much hype out there, all these different news casters, causing panic and fear. And it's definitely a tumultuous time, and it's a historic time for the financial markets and mortgages in general. But keep in mind that the housing inventory is not growing at the same pace that the demand for housing is. So the demand on housing is continuing to drive prices up. It's a great time to take advantage of the low rates and do what you can to get into the home, or restructure your debt with a refinance, especially if you have other debts that you could pay off using the equity in your home. This is a great time to do it while the interest rates are so low, and the cost can be super low as well. So that's all for now. Just wanted to check in with all the craziness going on to make sure that you know that I'm here for you. Can be calm in the storm, and help you make sense of all the different things that are happening, so that you don't get pulled in by some of the hype. I can tell you if it makes sense to make a move or refinance, or if you're good with what you have. So give me a call. Let me know how I can help, and what other questions that you have. Post them in the comments. Send me a text, email, hit me up on my social media. Any of these over here, and I'll talk to you soon. Let me know how I can help. Thanks so much. Bye-bye.